Our next guest says that markets will eventually shift focus to the likely tax hikes from the Biden administration, and a 5 to 10% pullback is in the coming weeks is a real possibility. For more on that and where yields might be headed, we're joined right now by Gene Todd, Executive Vice President at Fiduciary Trust Company. And Gene, I got to say, I don't know that that's a huge leap or a huge jump to make to say we're going to see a 5 to 10% pullback in the coming weeks, especially when you consider how the markets continue to hit these new highs and almost nothing seems to slow them down. What is it that you think that eventually changes the market's perspective and makes things come kind of back down to earth a little bit?
Well, good morning, Becky. And you're right. I mean, it's not a huge stretch because pullbacks, they happen regularly, on average 2 to 3 times a year. So we like to tell clients to expect it. And when they happen, it's scary. Doesn't feel very good to see the market down 5 or 10%. It happens rapidly. But it usually lasts about 30 days. And then the markets resume their upward trajectory. So, what we think is that that's a possibility, and it's sooner rather than later. It's gonna happen. But we do think the markets are going to be up at the end of the year from the levels that they are now. It's not going to go up on a linear basis. There will be bumps along the way. And as I think as people start to focus on the increase in the Treasury yields and what that means to valuations, and eventually people will start to focus on tax increases. The Biden administration has got a lot of things to focus on initially, but make no mistake, tax increases are coming, probably not in 2021, but there'll start to be some discussion about that. And certainly that'll be negative for the markets.
Here's what I wonder. We all know a pullback could come at any point, but are you convinced enough that it's here that you would be telling people don't invest at these levels, wait for that pullback, wait till you see a 5% pullback or greater before you put any money into the market?
So if someone is sitting on cash and they're thinking about getting into the market, then you need to layer that cash in. Don't put it all in today. Invest it over the next couple of months, maybe 3 months. But for individuals who are fully invested today, don't take it out. It's very important to stay disciplined, to be diversified, broadly diversified. And as we always tell people, make sure that you rebalance. And when you rebalance, it forces you to certainly buy low and sell high. So that's the advice to clients at this point.
But you basically think there is no alternative, like we've heard from a lot of people, that you have to be in the stock market.
Yeah, so it's going to be about, that's the point about being broadly diversified. I mean, what we've seen is these sector rotations happen so rapidly. They're very difficult to predict. It was big tech, and then it was stay-at-home names, and then we saw value explode, and cyclical, small cap. Now energy and financials are on fire. So it's impossible to predict what sectors are going to take off and when they're going to take off. So to the point of staying broadly diversified so you can capture when certain areas take off is what's a prudent thing to do. I think also, our advice is stay focused on what's going on internationally, particularly the emerging markets. We think the Biden administration is going to have much more favorable policies towards international markets. The dollar will continue to decline. That will be favorable for international, particularly emerging markets. And we're going to see a global reopening. It's not just a reopening in the United States. It's going to reopen all over the place. Commodities are going to continue to go up. That's a positive for emerging markets. So don't give up on being globally diversified.
Shepard Smith here. Thanks for watching CNBC on YouTube.